if we get a shallow recession, you quantify what it will mean for jobs in America. How does the magnitude of recession work into the dynamics of unemployment?
Yeah, let's just be clear that we don't have a recession in our baseline forecast. We do have significantly below trend growth. 0.9% is only half the long-term trend pace. Mm-hmm. But our best guess is that we'll be below trend. That rebalances the imbalance in the labor market, and that ultimately also helps bring inflation back down. That said, there's a very significant risk of recession. I think it has gone up because it's very difficult to reduce labor demand without the deterioration feeding on itself and then ultimately culminating in a recession. So we're giving a 1 in 3 chance of a recession in the next 12 months, and it's close to 50-50, I think, over the next 2 years.
But you've got 2% of unemployment rate baked into a 2001-ish kind of recession.
In 2001, it was a 2 percentage point increase. That was the bottom end of the historical range. If you look at all of the recessions in post-war history, the top end of the range is 5.5 percentage points. I think if we do have a recession, it's likely that it would be on the shallower end for 2 reasons. One, private sector balance sheets are in better shape than at the end of previous business cycles. And 2, I think, while inflation is very high, I don't think it's as entrenched, certainly not as entrenched in expectations as it was in previous high inflation episodes, 70s, early 80s.
Jan, we just got off a couple of weeks where people were ratcheting up their expectations for the terminal Fed funds rate to about 4% as of at some point next year. And here we are looking at a huge rally in 2-year yields. Can you translate the rally that we have seen through an economics lens in terms of what people are forecasting and whether it seems plausible in your mind?
Well, our forecast is a terminal rate of 3.25% to 3.5%. We think we'll get there by the end of 2022. We don't have any additional rate hikes in 2023, basically because the economy is decelerating, is growing below trend, inflation is coming down, and I think at that level the Fed would probably hold. You're right, we had priced something around 4%, immediately after the FOMC meeting or right around the FOMC meeting. But I think people have looked at the fact that the economy actually is decelerating, and that has led to a reversal of that. And I think fundamentally that's appropriate.
But Jan, given the fact that we are seeing a deceleration, but we're not seeing a deceleration when it comes to the inputs into inflation. We're seeing rents continue to climb at a record pace. We're continuing to see some of the disruptions to oil supplies and to food supplies that are causing some of the price increases. When do you start to talk stagflation? When do you start to talk about a Fed that is forced to act despite an unemployment rate that's rising and despite weakening economic data points?
Well, I think it's a little bit more mixed if I look at the inflation indicators. No question, the last CPI and the rent number there was bad. There was an increase in the long-term University of Michigan inflation expectations measure, but the supply chain measures are actually getting better. You look at the supplier delivery indices and the business surveys, those are coming down. The wage numbers in 2022 have been sequentially clearly slower than the second half of last year. And I think broadly speaking, inflation expectations, look at just the break-evens in the bond market, are still very well anchored. So I think it's a more mixed picture. And in an environment where growth comes down to a below-trend pace, I just don't think that the Fed would keep hiking aggressively when the economy is already slowing and inflation is already coming down.
So, Jan, essentially what you're saying is that when Chairman Powell was speaking on Capitol Hill yesterday saying that our commitment to fighting inflation is unconditional, that there actually are conditions in which the Fed blinks.
I think there are conditions where the Fed blinks, but it's partly because there's a feedback from economic activity into inflation. If the economy weakens and labor demand declines and maybe the unemployment rate starts edging up, then you're also just going to become less concerned about inflation. So I do think the commitment to ultimately getting back down to 2% is unconditional, but there will be factors other than the current inflation prints that will sort of drive what they do on a meeting-by-meeting basis.
While we're talking about the specific words that Jerome Powell has used, I've talked earlier in the show about the tweets Bill Ackman posted overnight talking about how the Fed clearly has a credibility problem. The bond market is misreading the Federal Reserve. And what he said is ultimately that comes down to the communication of the chairman. Do you think that Powell and others on the FOMC are accurately communicating to this market what it is they intend to do?
No, I think they are accurately communicating, I think, in ways that are clear, that they do want to get back down to 2% eventually. They're tightening policy aggressively, much more aggressively than they expected to do 6 months ago or 12 months ago, in part because inflation turned out to be much higher. So I think at that level, it's all pretty clear. On the credibility problem, I would also say, look at inflation break-evens. I mean, the credibility from the bond market's perspective or from the perspective of forecasters of the 2% inflation target still seems intact.
Yeah, and I want to go to Peter Orszag of the London School of Economics in a small banking shop in New York. Peter Orszag loves the phrase glide path. And maybe that's differential equations, but it's Friday. Let's just stay with calculus. Are we completely misjudging the second and first derivative of core inflation coming in where it may come in shockingly rapidly, and we underestimate that good news?
I do think that core inflation is likely to come down. In fact, if you look at statistical measures of core inflation, like the trimmed mean index,
Cleveland,
that
Dallas,
has been improving over the last few months. It's still a little too early to tell how much weight to put on it.
Agreed.
But the last couple of readings have been more encouraging, and I think that does suggest that over time, core inflation is going to come down. And we're at about 4% for core PCE, core in this case defined as ex-food and energy, by the end of the year, and then at about 2.5% by the end of next year. So I don't think it's going to happen overnight, but I think we're headed in that direction.
So when Jerome Powell says we get back to 2% inflation, that's what he's talking about. And Hatzius says Powell will get his wish in 18 months.
Not quite. We're at 2.5, but that's not too far away from 2%.
Yeah, 2 and 2.5. It's TV. Who's counting?
Especially if you look at this as an average inflation target.
Okay, yeah.
So at some point there will, whether there's a recession next year or not, our best guess is not, but there will be a recession at some point, and that will bring inflation down further.